tax advantages is the big one. Starting last year, it got even better, as we all know, with bonus depreciation, your ability to accelerate the depreciation on investment real estate is, I mean, how do you compare that really to anything else where you could generate very large NOLs and offset, mostly all, if not the majority of any gains, any passive income or any long-term capital gains, even ordinary income with those NOLs is extremely powerful. So when you take that and you take, again, that prudent mindset about buying right, being selective, not over-levering, it's hard to get hurt in this business unless you make very stupid decisions. So that's what it makes me think about, Brett.
I love it. I think that's spot on. The Trump tax plan has been very, very encouraging for commercial real estate to make finally kind of get off the bottom. I feel like we've been kind of, with the interest rates, things have slowed drastically. Welcome to the Build It to Billions podcast, where we guide successful entrepreneurs and investors on their journey from millions to billions. We believe the key to scaling and compounding your wealth and life starts every single day with a mindset and practice of stewardship over ownership and applying billionaire biblical principles. Our ultimate goal is to scale and compound your wealth and life so you can give more or all of it away to help MVPs. My name is Brett Swartz. Each and every episode, we're joined by the world's top entrepreneurs, millionaires, or billionaires, and they share their secrets, wisdom, and insights with us so we can all level up and make a bigger impact. And our next guest is no exception. He's an entrepreneur, business executive, investor, and philanthropist. He is proud to be the founder and principal manager of Crystal View Capital. With over 20 years of experience in real estate industry, he oversees all the aspects of Crystal View Capital's operations, including investment strategy, fundraising, asset management, and day-to-day operations. Currently, they manage over $600 million in real estate assets and continue to grow wealth by implementing a disciplined and astute investment strategy. This is mainly focused on mobile home parks and self-storage and so much more. Please welcome to the show with me, Matt Ricciardella. Matt, how we doing?
Good. Thanks for having me, Brett. Appreciate it.
Absolutely. For our listeners getting to know you for the first time, would you give us a little bit more about your story and your current focus?
Yeah. I'll give you an abbreviated version. Had very humble beginnings. From upstate New York originally, and I kind of got into real estate by accident. Was not a good student. Didn't graduate from any university. Never had a formal education. Kind of knowledge was more from the street, if you will. And so, when I couldn't make it in traditional university, I thought to myself, what could I do that I could make a lot of money in without a degree? And I kind of fell into real estate and moved to Southern California when I was about 21 years old. Became a residential realtor, and the way I built my business was through direct prospecting, phone prospecting specifically, door knocking, being very aggressive, getting in front of people. And it was hard in the beginning to build up that business, but it started to work, and then it started to kind of like compound and snowball. And from there, I kind of launched an investment career, because one day I cold called somebody and they said, why don't you just buy my property? And lo and behold, this was the days of ninja loans, stated income, no documentation. Thank God I had no money, no credit. I was able to get a loan, bought a duplex in Long Beach, California, sold it a couple years later, made a $350,000 profit, and that launched me into my investment career, and just kind of followed that same approach, Brett, where picked up the phone on a daily basis, made contacts to owners rather than working, through the traditional brokerage channels, went direct, built relationships, started buying smaller deals, turning them around, building management capabilities, infrastructures, efficiencies to run these assets, and then kind of transitioned into mobile home parks and storage, because it was mostly a mom and pop driven market, very fragmented and very inefficiently run. So kind of built my career off of it, and then did well and thought to myself, this is very scalable. I don't have the capital available to scale it. And then I launched the fund concept back in 2014, and here we are today.
Amazing story. I love it. Lots lots of, I think I haven't wrote the book yet. You should write the book, right? But I remember the days of cold calling and Marcus Similachap, 2006, 2007, through all the way to 2011. And to me, it's still the best training and the best experience. I said, if you can get through that for, 2, 3, 4, 5 years, you can do anything within sales and communication and solving challenges, especially during that time, right? So you bought maybe one of the more challenging times. Obviously, you still made a profit there. What other things did you learn through that crash and that downturn that helped you to propel where you're at today?
Be very selective in what you buy. Protect. One of my favorite mantras is from Warren Buffett: protect the downside, and the upside will take care of itself. And the only way that's going to happen is you have to have very robust deal flow where you could be selective. If you're dependent, you got 1 or 2 deals, and you want to get capital out the door, you're probably going to do something that you shouldn't. So if I could encourage anybody, whether you're in the real estate business, whatever your business you're in, build up your pipeline so you could be very selective and you could make intelligent investment decisions. So I think that was the lesson learned. Don't over lever, otherwise you're going to lose your assets. We always keep a leverage point here around 50% or less at Crystal View across the funds that we sponsor, and I do the same personally. So yeah, be very selective in what you buy, understand what you're buying, have a circle of competence, and don't over lever your assets to crank out a couple extra percentage points of return.
I think that's wisdom. And by the way, you can learn more about Matt by going to crystalviewcapital.com. crystalviewcapital.com. I think one thing that gets lost in the investment real estate world and just investing world in general is it's too much focus just on cash flow, which is vital. But there's tax flow and there's debt flow. This is what I believe, right? And I believe too often, of course, they're all connected with cash flow, right? But still, like, not separating each of them and being it's almost like, you have a marketplace, you have a micro marketplace, you have the street, you have the actual duplex or the 20 unit or the whatever, getting even more micro down on those and understanding that interest rates aren't going to stay low forever, Matt, right? I had a client tell me that a couple of years back and I'm like, really? I'm like, wow, really? And obviously this is where we're at. So how do you see that when you hear tax flow, cash flow, debt flow? What comes to mind?
Various things come to mind. I think, the real estate business in particular is just a fantastic business to be involved in for many reasons. Tax advantages is a big one. Starting last year, it got even better, as we all know, with bonus depreciation, your ability to accelerate the depreciation on investment real estate is, how do you compare that really to anything else where you could generate very large NOLs and offset, mostly all, if not the majority of any gains, any passive income or any long-term capital gains, even ordinary income with those NOLs is extremely powerful. So when you take that and you take, again, that prudent mindset about buying right, being selective, not over-levering, it's hard to get hurt in this business unless you make very stupid decisions. So that's what it makes me think about, Brett.
I love it. I think that's spot on. And the Trump tax plan has been very, very encouraging for commercial real estate to make finally kind of get off the bottom. I feel like we've been kind of, with the interest rates, things have slowed drastically. I think I call it 2026 or 2025 as the year of the tap out with those who, I'm doing jiu-jitsu with my kids as about a year now. And I'm like, it's been in an arm bar and everyone thought that finally interest rates would ease up. And now it's like, nope. And they're just giving it back, So what are you seeing in distress? And I'm curious, how did you position Crystal View Capital before this interest rate hike? Were you able to get longer term debt in place, and or how have you navigated these resets with these banks? And I'm glad that you said 50%, right? I always said at Marcus and Mailchimp, our goal was to get on the other side of the phone. And the guys who never lost are the guys who collected all of the pieces around the monopoly board. And they never sold, and they only ever leveraged up to 50% and bought more, right? Still selective. So I'm just thinking through that. How did you guys navigate, and how did you get through it? And or did you have some longer fixed debt where you haven't had to face the resets?
Yeah, all of the above. We've locked in a lot of debt in 22 and 23. Some of that is still in the threes, which is going to juice cash flow quite considerably. But I got to be honest with you, given that we're very acquisitive right now in our Fund 4 and beyond, I like the idea of a higher interest rate environment. And let me explain. I like it for several reasons. Number one, we hear this concept and this term of there's a lot of dry powder on the sidelines, and that's very true. I do think that capital flows are very sheepish and herd-like. So when everybody gets in the market, everybody jumps in at the same time. Valuations pop, and it makes it very challenging for groups such as ours to really extract value for our investors. But if there's limited players because they're all on the sidelines waiting for that proverbial moment when interest rates go down, it allows us to operate without competing. So I like that concept. The other thing is we're not really a core or a core plus real estate player. And what that means is if you've heard the term, I buy core plus real estate, basically what you're doing is you're getting very nominal value creation. You're just buying assets that are stabilized, and you're hoping and you're banking upon some level of cap rate compression so you could deliver value to your investors. That's not what we do. What we do is we buy assets that are underperforming or non-performing. We create that value within the marketplace. Once we're successful in doing that, our typical cap rates, or let's say a yield on cost, is going to be in the range of 7, 8, 9% plus. So unless rates kind of blow out materially from where they are today, we still are going to achieve positive leverage within a 1 to 2 year holding period. So we're somewhat insulated from this higher rate environment. So there's a lot that I just said there, but for those reasons, I don't mind this higher rate environment that we're in today.
Yeah, 100%. I'm gonna speak with Matt. I'm gonna spell the last name for you because it's a little bit handful. Ricciardella. Okay, and
Yeah.
you can find them and learn more about by going to crystalviewcapital.com. I love mobile home parks and multifamily. Mobile home parks, I feel, have that advantage of just you tell me what's multifamily versus mobile home parks. What do you when you're competing against capital flow to go to multifamily deals versus mobile home parks? Talk a little bit about the advantage there, and then also touch on self storage and why you like that as well.
Yeah, well, my favorite asset class right now is definitely manufactured housing communities, mobile home parks, as you referred to them. And comparing it to multifamily, you are seeing, and we're not tracking. We track multifamily. We don't really buy it. You're seeing more distress in that area, and I think a lot of that distress is capital markets distress, where groups have bought assets. Go back to 21, 22. They bought them banking on refining a couple years later at a 3.5% interest rate. They bought them banking upon 10, 15% revenue growth per annum. The market became very much oversupplied. Interest rates blew out. They're in a very tough place right now. So you're seeing distress in that asset class. When you look at manufactured housing, there's virtually no operational level distress. These assets run counter market. So to the extent that we enter into a recession, historically, these property types have performed better. Think about it as the lowest form of affordable housing that's out there. So you've got more and more demand as folks can't afford to buy homes, as interest rates remain higher, and people can't buy traditional stick-built homes. They can't rent luxury level apartments. They're more so coming into manufactured housing communities. They're getting a piece of the American dream because they could buy a home within these communities where they can't do anywhere else. So for that reason, it's become very much in vogue, where in the past there was a certain stigma that was attached to, trailer parks, trailer trash, and that's beginning to dissipate in a major way. These communities, Brett, that we own in particular, curb roads, clubhouses, health centers, great new double wides, curb appeal, pride of ownership. So that's kind of the evolution that this property type has gone through. And operationally, I mean, it's just fantastic. You know, when you look at, compare it for a moment, because you asked me the question, storage, multifamily, manufactured housing, the one element that I see that's different between manufactured housing compared to storage and multifamily is supply and demand. You have virtually no new supply coming to market, and you got demand that's growing off the charts. On the other two assets, in some markets, they're heavily oversupplied, and the demand really hasn't caught up with it, and you're losing your pricing power. You're losing your ability to grow rents, and obviously that's not happening in manufactured housing. So that's why it's our favorite asset class right now.
I love it. Yeah. And I'm looking back, we were grateful that we pivoted out of multifamily mostly after, basically 21, 22. And then we went with some of our clients into manufactured housing. And then a lot of real estate debt is where we've been mostly just waiting to see what would happen here, which kind of leads me to the next question, which is just capital flow. I love the way you put that. It can be sheepish, but it can also be locked up, I think. It's one thing to say, raise capital for a deal in an asset type like manufactured housing and self-storage. Another thing to say, well, where's the capital coming from and what's the barrier for them to get into? So some folks have self-directed IRAs and, the self-directed 401ks, and that's a piece of it, that avenue to help to make it more tax flow efficient. I'm curious, what's your biggest frustration when it comes to 1031 exchanges and the ability to not be able to 1031 into a fund, unless you have another way around that, and or just from big business exits or Bitcoin or stock that has seen some rapid appreciation that want to get in with you, Matt, but they have to pay a bunch of tax and then show up later on with the capital. I'm going to offer you a solution here in a second, but I'm just curious, if there's a way to 1031 from any asset of any kind into your fund, how much more capital flow could come into you guys?
Well, a ton, but as you mentioned, and you're correct in what you said, they're not able to. The reason why they're not able to do a 1031 exchange into a fund vehicle is when you're doing a 1031 exchange, it needs to be like kind, as the IRS identifies it. When you're selling real property, a like kind exchange is another piece of real property. When we issue units within our fund, they're considered securities. So therefore, the like kind requirement is not being upheld. And that's not going to facilitate, for tax purposes, a 1031 exchange. However, I will say this is what a lot of property owners in our asset classes have done, and it's very astute on their part. They've done this is a lesser known section of the IRS code, and before I get into it, I do want to make the disclosure that I am not a tax advisor. I'm not rendering any tax advice. However, I'm just pointing out what some of our investors have done. They've done taken advantage of Section 721 of the IRS code, which, think about it as an UPREIT structure. So they own an investment. Let's say they own a mobile home community. We would like to buy it. What we would do is they would contribute that asset into the fund. That's a tax neutral event, so the tax is deferred. They get units or equity in our fund. The fund gets the asset. Both sides win. And it's very tax advantageous for that particular property owner. So a lot of owners have taken advantage of that section within the IRS code. But in terms of exchanging into the fund, again, that's not a possibility.
Yeah, absolutely. And so this is part of why we built our company, Capital Gains Tax Solutions, to eliminate the need for the 1031 exchange and put tens of millions of dollars into passive real estate funds. I'm going to tell you a couple of deal stories to bring this to life. So we had some clients, and this is right around 2021, 2022, just before 2022, $13 million car wash that they built in San Diego. It was an old taco stand that they combined the two parcels for two, and then built about a $4 million car wash and put the taco stand inside of this car wash. Well, fast forward, the property is worth in the business, total about 13.5 million. Well, that's a large tax, and Taxifornia plus the state, plus the federal, is about 37-40% is going to be hit with the gain. And so at the same time, they're going, Brett, this market's crazy. We couldn't believe we're getting 13.5 million. Interest rates are so low. We think it's the peak. We don't want to sell high and buy higher in the same marketplace. And we're like, exactly. That's what a 1031 often forces you to do. So instead, we built trust for them where they could sell to a trust, and trust gives them a promissory note. And then the trust ultimately sold it to the ultimate buyer. Smoke clears, funds are at Schwab, and they've been able to invest into passive real estate funds. Some of them put them into Bitcoin at a low valuation, stocks, money market accounts. And we've been waiting for these few years, and now we're here. Now their goal is to go back and buy land at a discount, which has taken a while to kind of come around, and build more car washes. But in the meantime, they've been diversified within multiple real estate funds, all passively, because it's not using 1031. We're using 453, which is a seller carryback, and we're combining that with a third-party trust, where we're the trustee on how we work it out. But these things, I think, are just so missed in the real estate world. And they also work for businesses. We just did a $70 million business exit for a client up in the Northeast, and 1030 doesn't even qualify, right? And it's completely missed, I feel like, and I think there's opportunity for real estate fund managers like yourself to explore these types of things. We've done it for Bitcoin. We had a client who bought Bitcoin for $50,000. Went to 54 million. We exited at 5, deferred all the tax, and same thing, passive real estate, passive stocks if they want to. They can also be active and partner with it. So if people want to learn more, go to capitalgainstaxsolutions.com. But I'm curious, Matt, have you ever even heard or even thought of a strategy like that, not using 1031, but 453 through an installment sale, where once it's in this trust, it can go right into your entity, all tax deferred, just like any entity would, an LLC or a trust or whatever?
That's obviously a more sophisticated approach. Now, some sellers have sold to us on seller financing, but I don't think that's what you're referring to. I think what you're
Correct.
referring to is a little bit more of a sophisticated strategy about setting up a trust, selling into that trust, and perhaps that trust turning around and investing into a vehicle such as ours. I mean, I think that would really come down to whoever the tax advisor is for that particular seller. But to go that deep into an approach, we have not done that.
Yeah.
However, I will say this: you made an earlier comment around, hey, how could you kind of offset or defer some of the gains perhaps in public markets, whether it be Bitcoin, low basis on a publicly traded equity, whatever it may be. Again, I'm not a tax advisor, but when you sell a financial asset and you buy into real estate, and there is a component of bonus depreciation, which is going to generate an NOL, from what I've seen, those NOLs are going to offset, to the extent they can, you have sufficient loss, go to offset those gains on those financial assets that you've sold. So there's that possibility as well. But I do like your approach on the trust, and it's nothing that I've served up or recommended to anyone.
Yeah, and that's part of why we're talking. It's good. It's always good to explore different options. One other thing that people miss is that depreciation is not on Bitcoin, on stock, or if you fully depreciated an asset for 27.5 years for multifamily or 39 years for commercial, you run out of that number one thing for real estate, which is depreciation schedules. And so the goal is to get a new depreciation schedule. The challenge with the 1031 is the old depreciation schedule travels, okay? And/or doesn't even have a depreciation at all. So another part of the strategy, which is kind of cool, just add another ninja trick here. You can partner with these trusts through a new LLC, which establishes a new depreciation schedule. And then you can invest into assets like you're talking about, Matt, like you have, and let the 100% bonus depreciation flow through a partnership of which the seller can have the majority ownership. So picture this: you have $100 million of Bitcoin, no depreciation. You've depreciated 90%. Let's just say you bought it for 10 million. You could sell, defer all of the tax, and then partner with the trust, let's just say 50 million into an LLC, put that into like a fund like yourself that's producing the 100% bonus depreciation, and that it'll flow through to that LLC. And so in a sense, we're kind of manufacturing depreciation schedules, right? to establish this cost seg to flow through, right? And so these are just some of the things. And the last one I'll say too is the one that we're missing is the estate tax, Matt. So many people are focused on cap gains, which is the tiger by the tail, but the estate tax is the elephant in the room. Now it's up to 30 million married, 15 million single, or the exemptions, but the stepped up basis is not solved for that. So if you have a client or you're out there listening and you're worth 130 million, and let's say it's all in mobile home parks or multifamily properties. In fact, I'm talking with a gentleman right now, Matt, I think I'll connect you with him. He's got over $500 million in mobile home parks, and he's probably 65, 70, and he's like, hey, I don't know what to do here because I have this huge estate tax and I can't gift it away fast enough. I can't buy enough of life insurance, and I don't necessarily want to give it all away to charity. I still want to be in the game and my kids to be in the game once I pass, but my estate tax is going to hit me with a 40% death tax. So I said, look, this is what we're going to do. You're going to sell it to an irrevocable trust before, when you have the buyer lined up, and then the trust will sell it to that buyer, and you'll remove it outside your taxable estate. You'll make your kids the beneficiaries, but once those funds are there, it's forever outside your taxable estate. They'll pay tax as they receive payment back over time because it's kind of like an installment sale. But the point is, that's a big piece that people are missing. And I think the mindset for those who want to really 10x their capital flow is to look at ways to unlock the capital, right? Not just raise within the box. And that to me is what's, you solve the problem. You solve a big enough problem, people will show up, right? Anyways, that's just another thought for people who are listening. If you have an estate tax challenge, any last thoughts on that before we go to the lightning round, Matt?
No. I mean, again, I think you're thinking very creatively outside the box, and sounds like you're solving some problems for some higher level folks. So I think it's fantastic. But nothing to add. That is not my area of expertise. Full disclosure.
No, all good. Let's move to the lightning round. So, top deal that you're looking at, and/or how many deals are you guys closing on right now? What's your sense of the marketplace? You can make it a little longer than the lightning round. You don't have to be real quick on this, but like, what's your sense on mobile home parks and self-storage right now, and the opportunities that you guys have to buy?
Yeah, we have about 80 million in our pipeline right now, Brett. It's all manufactured housing. That's really all that we're going after at this stage for the reasons I had mentioned. And again, we feel really good about it because we're just not competing. We're getting real value in the marketplace, and a lot of these groups, back to capital flows, are waiting on the sidelines for interest rates to come down, and they're not. And if they are, I don't know when it's going to happen. I wish I could predict it, but I can't. But until that time comes, I'm going to continue to capitalize on the market conditions, which allow us to really extract some decent value. And that's exactly what we're doing for our investors right now.
Excellent. Any particular states or regions that you're focused on?
We're in 31 states presently, so we've got scale, almost across the entire country. I will say this, we are more Midwestern focused. I think it's just because of yield. It's tough to go into California and really create that value like we have historically. It's tough to do that in Florida. It's tough to do that in states like New York. But when you look at states like Michigan or Ohio, Indiana, Wisconsin, there's a lot more opportunity to create yield in those marketplaces.
Excellent. Now we're actually moving to the lightning round. If you go back to your 20-year-old self, what's the one golden nugget you would make sure to tell yourself to do?
Don't give up. Everybody's gonna face these challenges in life and in business, and people are gonna tell you that you can't do it, and hey, you should take the safe, predictable route. Don't listen to them. If you're passionate about something, if you believe it in your heart, don't give up on it. Just keep pursuing it diligently every day, and you'll get there.
Love it. Question number 2: what's the number one book you recommended the most the past year?
Lots of books. I mean, I would say this: Think and Grow Rich, is obviously a classic. I think you talked about biblical principles. Read the Bible. I think you can't go wrong. You could get some great financial advice there. Read anything that Warren Buffett wrote. He's got annual reports going back to 1955. I think you'll get far more out of that than you can any business school.
Love it. Question number 3: number one way you guys are using AI at this point with the company or yourself?
There's a lot. Operationally, we're taking data and making real-time investment decisions based off the 20 years of data that we've stored in our warehouse. And now with AI, it's amazing. We get to analyze that data and understand supply and demand in markets, where people are moving. It's just remarkable and also finding sellers. We have a database of sellers, and that data is scraping it, and it's understanding, where we should put our focus, where rents are at market, below market. So we're using AI in so many different ways to create value. It's amazing.
Love it. I just got going in with cloud recently, just over the weekend, honestly. And I think I'm shifting my entire team operations from chat GPT all the way to cloud because of the co-work and the coding ability. It's pretty incredible stuff. Next question, number one leadership quote or theme that you strive to live by.
I guess the golden rule: treat others like you would like to be treated at the end of the day.
Mm-hmm. Awesome. Great. And the last question, we'll wrap it up. After all your success, helping all the people you helped, and building the business you built, how do you best keep a mindset of stewardship over ownership?
It's an interesting question. I think Charlie Munger said something that really always resonated with me. I think he talked about partnership. To be a great partner, he said, deserve to be a great partner. Or whatever you want in life, deserve it first. Be a great steward. And when we go to owners, that's how we position ourselves. It's not, hey, we could strike the largest check. We position ourselves as, we believe we're the best steward for this asset. We're going to make you proud. Your family built it. This is a legacy for you. And we're going to work really hard and continue to invest in the asset. And we think we're the best steward in the market, not we could strike the largest check.
Amazing. Matt, I wanted to thank you for being on the show, sharing your wisdom with us and insights. And I want to encourage you to keep using the gifts you've been given to bless and help people get affordable housing, right? And to make wealth and build wealth in a really tangible way that's so needed in this housing crisis across America. For our listeners who want to get in touch with you, Matt, one last time, what's the best place for them to find you?
You could visit our website, www.crystalviewcapital.com, or if you want to receive more information on the company or the strategy, it's invest@crystalviewcapital.com.
Awesome. Thanks, Matt. And I also want to thank all of our listeners for listening or watching another episode of the Built to Billions podcast. We're also streaming on Capital Gains Tax Solutions podcast and YouTube channels. Hey, we're on this journey with you to scale it from millions to billions, to give more all the way to help MVPs, the most vulnerable people. I want to encourage you to take this episode and consider looking at Matt and his team to invest in manufactured housing. And if you have a large exit, to be a great steward of doing your due diligence on the exit strategies that can multiply freedom and impact for your family. We want to consider us. We have a book called Building a Capital Gains Tax X Plan. You can check it out on Amazon, or just go to capitalgainstaxsolutions.com to learn more. It could be Bitcoin, business, real estate, any exit of any kind. Check us out. We appreciate you listening or watching. We'll talk to you again real soon. Bye now.